Good day, folks. The next section we move into is cash flow. Cash flow, as we've said, is the lifeblood of any successful business. And as Richard Branson has a quote here, never take your eyes off the cash flow because it's the lifeblood of the business. So it's a very, very important thing, and as a result, we need to take a look at it. Cash follows the business cycle. So we have in the case of Geneseo Coffee Company, we have the business cycle is buy coffee beans, cash goes out. Roast coffee beans, cash goes out. Then we sell them, and there's still cash out. Finally, we get paid for cash in, and we start the cycle over. So in these three parts of the process, we use cash. Cash comes in here. So we always have that cycle, but if we want to grow, we have to have enough cash to start here, because the profit comes in here. Okay, there's two things that we use cash flow for. Manage the day-to-day processing of cash, where we have it, what do we need, and understanding the sources and uses of cash. Understanding liquidity within the company. So those are the two things we really do in the management of cash flow. And when we look at the cash flow statement, it really walks us through and said, where did cash come from? Where did it go? And what's left over? So if we start out with cash at the beginning of the period, add in where cash came from, where it was used, and the ending amount should be our change in cash balance. Now, when we look at if we have cash flow problems, what do we have? Well, generally that's an indication of lack of profitability. We don't have enough working capital to make our business grow or to keep things moving. With a cash flow problem, you may not have enough funds in your account and you may go overdraft. And if the bank pays it, they may. But if not, there's still going to be fees associated with that. It'll be tough to make payroll. And a lot of times in small business, the person that doesn't get paid is the owner. Creditors can get a little angry if you don't pay them. And then taxation in arrears. Now, what that means is and I'll give you the best example is sales tax. So if you as a company sell something that has sales tax on it, you have to submit that to the taxation authorities. But it's generally not due. It's done on a quarterly basis. So the cash may come in, you may spend it, and then all of a sudden at the end of the quarter when the tax is due, you may find that you have tax due, but you already spent the money. That's because you haven't put it aside. But these are some of the things that cash flow problems can. I would say in a lot of small businesses are shut down because they didn't pay their sales tax. So the cash flow problems arise in many cases because companies don't have an understanding of their cash flow. Okay? And that's where management accountants can be very useful in providing that information. Now, we look, and this you should have covered in financial accounting, but it's the cash flow statement. Operating activities, investing activities, financing activities. So we look at how cash flow in and out into these three different categories because they're each unique and separate, and we can learn from them. So cash flow from operating activities is pretty simple. It's net income. Then you add back non-cash expenses, subtract non-cash income, and changes in working capital, and that gives us cash flow from operating activities. Now, what we're trying to do is net income is based on the accrual basis, which represents this matching of revenue expenses. But we're trying to turn it down into cash. So a lot of times net income doesn't equal cash flow. Okay. Okay? And what we're looking at is for major gaps and differences. If a company is reporting net income but not generating cash, we have to ask what's going on. Is there a misstatement in the accounting? The company WireGuard, that would have been a clear signal to us. So let's start with why, right here, we're coming back here to this non-cash expense. So as we take a look at that, non-cash expenses are added back. Okay? They're expenses, and they're true expenses, but they are not, it's not necessarily a function of current cash. Depreciation is probably the biggest one. The cash went out when you bought the equipment, but the equipment is going to last and provide benefit to a company over a period of time. Same thing with amortization. Stock-based compensation didn't cost us anything in cash. If we look and say, okay, a receivable or loan is going to go, we think is going to go bad, we make a provision for that. That hasn't used the cash yet. Unrealized gains and losses. All of these are examples of non-cash expenses or revenue. They're associated with cash inflows, but it's a reversal required when we actually pay the cash out. And these things that we have all are around the working capital cycle again, from raw material to finished goods to receivables to cash. So working capital, if you call, is current assets less current liabilities. So that's the actual working capital. But let's take a look here at this is a sample cash flow statement, and we're trying to hear net cash flow provided by operating activities. So we see net income, then we see here there was an asset impairment charge, depreciation and amortization. As I said, this is primarily the biggest one you will find. Stock-based compensation, deferred taxes, gain on sale, foreign translation. All of these are not one time, but these are adjustments. They didn't require cash. Okay, so we're converting that net income to taking out things that didn't use or provide cash. But then we have remember, we're following the working capital cycle. So changes in the balances associated with these working capital items, receivables and inventories, and on the liability side, as they change, they either use or provide cash. Everything that's in this section right here, okay, is related to the working capital cycle. It doesn't include anything long-term, non-current assets. They're handled differently. So there's really those two parts. And you want to make sure you can calculate this. Here's an example from a company. I just made it up. They start with net income, $108,000. They made adjustments to reconcile net income to cash flow. Depreciation. So the first thing on depreciation is they depreciated some equipment during the year. So if we actually look at accumulation depreciation account, say on the building, it was $58,300 at the beginning of the year. They booked a $7,000 depreciation expense, so $65,300 is the new balance. So what it does is we add the depreciation back because it didn't require cash. Step 2, gain on sale of land. They sold a piece of land. It's not, so we take a look at that. We look at the income statement and we see that. Proceeds include a gain. Okay? The gain is deducted from net income in order to determine cash flows from operating activities. We'll report the gain under of investing activities, because if we sold this piece of land that was previously used as a non-current asset and it was used long-term in the business, So remember that all that goes into the cash flow from operations is current working capital type items. Okay, so this goes in the other one. So we deduct the sale of the land. So that's number 2. And here we take a look at the changes in current operating assets and liabilities. Could read changes in working capital. And we walk through each one of them. You can do this. I'm not, but there is a change of $9,000 in receivables. Inventory 8 went down, went up, down, up, down. So these are all changes in that working capital cycle. So that wraps up cash flow from operating activities. This is going to serve as the basis for other components of analysis that we will do around the cash. The next thing is cash flow from investing activities. What are you investing in right now to build the company for the future? So think about it as an investment in the future. For yourselves, it's education. Your education is an investment in the future. Now, if we buy something, okay, long-term assets, often called CapEx, capital expenditures, generally we're buying. Now, if we sell it, that means we're reducing a capacity or reducing our future assets. They may not be worth it. We may not need them anymore based on where we're going. But purchase sale of long-term assets is one. We buy and sell other businesses. Okay? And then purchases of marketable securities. Now, marketable securities are not part of the working capital cycle. Okay? When we go back up here, there's nothing called marketable securities. That is really excess cash that we don't use in the working capital cycle. So we report them there. So this is an ongoing thing, and when you look at it, we want to look at each long-term asset account for its effect on cash flows from investing. Did we use cash to make these? Did we sell something? Important to distinguish, this is not part of the working capital cycle. We then have cash flow from investing. If you look at it, sale of inflows come from sale of long-term assets, sale of investment securities, collection of non-trade. The outflows, purchase of long-term assets, purchase of investment, creation of non-trade receivables, for example, an owner. That nets up to cash flow from investing activities. Then we move on to financing. Okay? And this focuses on how we're funding the company long term. We can either fund a company through equity or through debt. So when we're looking at them, when you issue new securities, that generates cash. When you buy them back, that uses cash. When you get new debt, okay, you're going to issue new debt, you're getting cash. You pay it back, it's using cash. You pay a dividend to shareholders, that's using cash. So what we have is in this section, anything directed towards capital. Capital, as you remember, can be equity and debt. Okay? So if we're looking at this down here, again, I'm going to repeat this. Transaction with lenders. Borrow is positive. Repay is negative. Transactions with shareholders. Issue new shares, including those under stock compensation agreements, is positive. Purchase shares, negative outflow. Pay dividends, negative. So that's cash flow from operating activities. And when we look at this template, if you will, we start out with net income and we reconcile to net cash provided by operations. Okay, them are the reconciling items. Cash provided or used by operations. Cash provided used by investing activities. Financing activities. Net increase, decrease in cash and equivalents, and that when we add it to the cash at the beginning of the year gives us the end. So this is what you can see how we've got this broken out here. First we got operating activities, investing activities, cash flow, Here's the net increase in cash, cash at the beginning of the year, the ending. So we're always coming down. In this case, 23,000 was the cash flow from operating activities. We add back depreciation, change in working capital. Cash provided by operations is 25. This is pretty good. You want to always make sure that they're close. So how else is this used? We use this information in strategic planning, where we're going, budgeting, cash management, the future of the company, and to understand our liquidity. How can we go? One of the final points on this. Net income is not cash. Cash flow from operations is what matters over time. Accounting could inflate income and indicate problems. We'd like to see cash flow equal to or greater than income over time. These statements tell us how the company is using the cash it generates. So if operations is throwing off cash, how are they using it? Are they preparing for the future? What are they doing for their capital structure? So it helps us a lot in the planning process. Now, if we take a look at, this is AutoZone, which you did for Project 1, we can see that they made $1,617,000. Here are the expenses, depreciation being the big one, followed by these items which are not cash, and changes in the operating assets, working capital. So the cash provided was $2,000,000,001. So now when we go up here and look, income was reported at $1,600,000,000, but yet operations threw off over $2,000,000,000. That's telling us that there's real cash there. What did they do with that money? Well, capital expenditures. They spent under $500,000,000 in that. And that was the bulk of it. There were some changes, and they did dispose of some capital assets. Okay? And that's a piece there. You can see that. And it's almost the same. It's almost 100% is the CapEx. Okay, so of $2,000,000,000, they invested $492. So the question then becomes, what do they do with the other $1,600,000,000? Because cash, if we come down here, didn't change. It actually went down. So what did they do? Well, they paid off some debt, issued new debt, paid some debt, issued some common stock based on the share-based expense. But look at here, they purchased $2,000,000,000 of treasury stock. So what they did is they bought shares back from the public because they felt they were underpriced and that there'd be more value in buying them back than investing in things to make the company grow. So that's just an example there. Just to summarize, the cash flow means the amount of cash flowing in and out of the company. In order to keep a record of the cash flows, organizations prepare a cash flow statement. They provide certain information, not everything. There's a lot more that we get. But we look at it in operating cash flow. What comes from day-to-day operations? Working capital cycle. Investing. How are they investing for the future? Financing cash flow. Now, that's the type of cash flow. In the next lecture, we're going to move on to free cash flow, which is based on that and another way that we manage cash. If you have any questions, please let me know.